UAE's demand, if this is going to drag out and is such a huge price risk, plus they're kind of friends, right, the Saudis and the UAE, why not just say, okay?
Well, traditionally, they have been friends and very much in lockstep. The issue is this time, though, that the Saudis say they cannot accept the UAE's demands, because if the UAE's baseline for production is increased, then everyone else will have to renegotiate theirs as well. And it's a grouping of 23 nations, and so the Saudis say that's just unfeasible. What's actually surprised some people in the market is how all the other members of the group, aside from the UAE, have accepted this proposal, and that the UAE is the only one saying, hang on, we don't want an 8 months extension to this deal until the end of 2022 without a renegotiation of the baseline.
Paul, who has the most to lose here if OPEC does adopt what the UAE is asking here? I mean, is it Saudi? Is that why we've gotten so many vocal comments, or is it Russia, or otherwise?
To be honest, it's probably all of them. All of them have a lot to lose if something goes badly wrong. Few people are predicting something as extreme as another oil price war. We had Goldman Sachs on Bloomberg TV earlier, and they said that situation is extremely unlikely. And it seems as if neither the UAE, nor the Saudis, nor the Russians, nor anyone else would want that. So at the moment, it's a case of how do they get a deal that satisfies all parties. The different countries within OPEC Plus could handle lower oil prices to varying degrees, of course, and the UAE is actually in quite a good place as far as that's concerned, given it has a low fiscal break-even as far as oil prices are concerned. But no one within the group would be happy with the prospect of much lower oil prices and some kind of price wars.
Paul, what if they just make an agreement that lasts, say, a number of months, a Band-Aid, if you will, and then all sit down and do the hard work of renegotiating everyone's baseline? What if is that maybe the necessary fix?
That is a possibility. That could be one thing we see, that OPEC goes ahead with the proposed increase of production in August of 400,000 barrels a day, which is something that the UAE itself agrees to, and then the baseline and the extension is they're discussed later. The problem is at the moment that the UAE and the Saudis are so adamant as far as differing stances are concerned. As you said, they're airing their grievances in public. They're talking to Bloomberg TV about them, which is something extremely unusual for OPEC. They like to discuss things behind closed doors. They like to give the impression of being cohesive. They do not like spats going public like this.
Yeah, definitely interesting to see. And of course, there's that offer from Abdulaziz to talk to Anne-Marie Hordern. Again, Bloomberg's Paul Wallace, thank you so much for staying on top of this story for us. And just looking at oil, prices still moving higher above $76 a barrel for Brent. Now, coming up, we talk to Tom Kinmonth, ABN AMRO Research and Investment Strategist, about OPEC, about the view for Europe and the U.S. We'll have all of that next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Markets. I'm Matt Miller in Berlin with Danny Berger in London. We've got a lot going on for holiday. Well, I mean, in the U.S., it's a holiday, Danny. Of course, it's not the 4th of July, it's the 5th. But like many nations, if the holiday falls on Saturday or Sunday, the federal government is kind enough to shift the actual day off you get to a Friday or a Monday. Typically, that makes trading a little bit light everywhere else, and I wonder if that's what we're seeing here today as well.
I mean, volumes definitely look light today, Matt, but kind of one of the things that are interesting about these holiday markets is usually over the summer, again, this is typically, if history is any guide, volatility tends to be lower over the summer when you have these different holidays. But I wonder if this year around, when you have all of these geopolitical concerns, be it OPEC, you can see moving the price of oil up there, be it the Delta variant, what have you, that maybe people are going to have to be more tied to their desk than usual. So S&P futures down slightly, bond futures a slight bit there, and the dollar also a little bit weaker. Now, one place that had trading today, plenty of volume to be found, was China, when we have concerns over Didi and the Chinese government cracking down on big tech in general. Yet the index ending the day higher. Yes, only by 0.1%, but within there, tech also ending the day higher. One area, though, that continues to look pretty weak, however, is Europe. If you look at what's happening in the Europe Stock 600 and what's leading us higher, what's leading us lower, it really is UK stocks that's outperforming. The FTSE 100 up 0.2% versus the DAX, for example, which is down 0.2%. What's behind that? Some of it has to do with merger news. Some of it has to also do with the oil story, those oil majors carrying the benchmark higher. We also have banks as well doing better today, Matt, up 0.9%. Despite the ECB said to banks on Friday, you need to remain cautious when it comes to dividends. You can't play catch up with the U.S. just yet.
I got to say, any merger news would be really interesting, Danny, because I've never heard of an actual merger, you know?
Oh, Matt,
it's usually...
I knew as soon as I said it that you'd have an issue, but I didn't stop to correct myself. It's not a merger, Matt. It is a company or a private equity firm that wants to buy Morrison's, not merge with it. They want to buy. It's
always one party buying another. There's a buyer and a target. It's very rare. I can't think of a great example of two companies getting together equally and merging. You know,
yeah, I can't either.
On a larger level than a wedding. I don't know that exists. The word just bothers me, but I appreciate the report nonetheless. Concerns over the Delta variant spread across the U.S., threatening to cloud recovery outlooks, putting a growing chorus of investors on edge.
The Delta variant. The Delta variant, the spread of the Delta variant.
The Delta variant is going to be an issue.
Definitely, it is right now the key tail risk to watch.
The risk is there. It's the major visible risk.
And it could potentially derail things.
The travel restrictions are still in place in many countries.
That can open the pathway for lockdowns. Later.
Economic growth forecasts could roll over.
But the issue is that the central bank's responsibility is also for looking at the economy and inflation.
This is the risk that we all have, on our radar, right? The Fed crunching the recovery.
That's still the big uncertainty.
Central banks have to calibrate very, very carefully.
Now, of course, we have seen the restrictions elongated in The UK, as a result, serious travel restrictions that continue on to this day because of the Delta variant and fear around it. Is that founded? Will we continue to see lockdowns? Joining us now is Tom Kinmonth, ABN AMRO Research and Investment Strategist. Tom, what do you think about this reemergence? Are we going to see Europe go back into a lockdown situation later, really hurting the economic recovery?
It's a great question. It's still developing. Obviously, as we know in the UK now, they're kind of taking a different path, maybe to reopening at the moment. Obviously, within the Eurozone, the key question is that we've got so much supply side in the economy. Excess liquidity has gone up 140%. And really, the focus will be on the demand side over the summer period into next year. But essentially, the ECB is trying everything it can to stimulate the economy. From one side, bank profitability is negative. That will harm the impetus. But we've got so much liquidity, but demand hasn't been there recently. This summer, we don't expect a massive rebound in corporate lending, for example. And towards the end of this year, it could really begin to suffer again. So it's not the greatest story then for the European comeback.
What happens with all this liquidity? I mean, I can hear it sloshing around, and yet the ECB isn't anywhere near pulling back on the taps. The fiscal side in Europe hasn't been as supportive as it has in the US, but do we face the same kind of risks?
Essentially, that fiscal discussion has not become one that would be nice, but is essential. It's really now, monetary policy has really reached that limit because excess liquidity is over 4 trillion. We've had TLTRO over 2 trillion now into the economy. Absolutely massive, massive liquidity pumped in. But the demand, especially in corporate demand in, say, the last 6-7 months, has been very lackluster, and that'll be a key focus. Then that means, okay, we look at fiscal ability that countries will have. That is looking very good. The ECB, even if it did get inflation, which isn't our base case, we're very dovish on core inflation, even if it did come through, the ECB would want to let economies overheat. It would want to help economies. Italy will probably have government debt to GDP up over 170%. It's going to need everything it can over the next few years, and that makes us very dovish on flat curves, low rates for longer.
Yeah, given that liquidity out there, given all the debt that both corporations and sovereigns have taken on, should the ECB act sooner? Of course, not saying that they will, but should they? Can they handle that? Given the debt picture, is that something that the market could cope with?
Well, essentially, the argument could be that could the ECB do more to help? Obviously, the market is looking at the US, seeing how great inflation could come through. But in Europe, the argument could be, well, actually, core inflation for the next 3 years, for the whole of Lagarde's term, could never reach its target. So on that other side, debt has begun to be built up. More debt means lower rates for longer. On that side, we obviously have aging demographics on top of the debt burden that's coming through. In the short term, we have to have some of this excess liquidity repaid. And obviously, the impetus there with the banks is that banks need good profitability. Bank profitability in Europe is around 7% ROE. In the US, it's well over 10%. And that's the problem, that if banks aren't making profits, they can't feed it through to the economy. Fiscal unity there will have to take over and begin to do spending. But it is a tougher time for Europe and very, very different to the US story.
When is inflation going to be at a level here that the ECB, and growth, that the ECB thinks it's okay to start reducing the asset purchase program, if ever?
Well, next 3 years, we'll have inflation below the target. That's been the way it's been for a number of years now. And really, we're already beginning to unwind some of the items. So that's going to be negative for the financing conditions, especially to the real economy, which is the area there. There may be pressure on the purchase program from some of the hawks to begin to reduce the pandemic purchase program down. We could see that in 9 months. But overall, the pressure there will be for the ECB actually to do more to help economies and really begin to feed that through. And this is the problem now we're beginning to see, especially in Europe, is a lot of asset managers and pension funds taking more risk. Greek government bonds are at 0% return. Subordinated debt in Italy, in Greece is at 4%. And dividend yields, for example, on Unilever is at 3%. So we're beginning to see pension funds, asset managers taking far more risk, potentially than they should be. And that fed into, for example, the green seal collapse, negatively impacting financing conditions. And this chase for yield now is causing this risk-return dilemma for a lot of funds, asset managers, and that'll be a focus in the background for the longer term of the ECB.
Tom, thank you very much for joining us today. That's Tom Kinmonth of ABN AMRO. Now, supply chain disruptions are raising costs for European companies as firms pass on higher prices to consumers, and that's also amid surging demand. Now, the French industry minister weighed in on this as well.
The point is now to have the most people being vaccinated in the less time possible, and to ensure that we have a close monitoring of the circulation of the variants. And this is exactly what we are doing. We don't have issue with number of vaccine doses. The people are getting vaccinated. We don't have a threshold yet, but we do know that at a point of time, we may have this threshold of vaccination, and we will need to push more vaccination among people.
So it is possible that this Delta variant could derail the very high growth forecast that France is enjoying at the moment, 5% for 2021. It's possible it could derail this forecast?
We don't think so, because we have taken cautious figures. As you know, we say 5%, INSEE is now saying 6%. We will not move our targets because, you know, it can go up and down, and we want to have a steady approach. But I'm confident that we can deliver this 5%.
The pandemic has also had a dramatic impact on the prices of raw materials, causing inflation. Do you think this will have also an impact on French growth, and this will have an impact, a lasting impact on the French industry?
We have some factories that have to slow down their production. They have a huge backlog, but they don't have the parts to produce yet because there are huge delays in production in Asia or other parts of the world. When it comes to pricing, by the end of the year, we believe that the inflation should be, you know, in a acceptable level. We don't have warnings regarding that. But once again, this has to be closely monitored, and that's why we're anticipating it by having some policies to re-implement, to relocate some production in Europe, in France, and to have a nearshoring approach.
President Macron is planning to revive the very controversial pension reform quite soon, before the end of his mandate, obviously, and the presidential elections in 2022. Do you think it's the right time, even though it could create another very tense social climate and possibly return of the yellow vest protests, for example?
President Macron has always been clear that he will not stop reforming the country because of COVID or whatever. We need to transform France, and we will carry on implementing reforms. Having said that, we need to have a pension reform, because at this moment of time, this is the scheme, the pension scheme is not balanced, it's not financed yet. That means that the younger one pay for the older one, but they don't have the insurance at all that they will benefit from the pension scheme at the level of the older one. And this is absolutely unacceptable. So we need to move forward with what calendar the president will tell, but for sure, reforms are still important in France.
France's industry minister there speaking to Bloomberg's Caroline Conan. Matt, I think part of what this price hike discussion is really interesting about it is this idea of whether consumers are willing to pay more, because historically they haven't, right? But they do have more money in their pockets now.
Yeah, absolutely. I think there's a lot more liquidity out there, not just on Wall Street, but also in savings accounts. The question is still, though, is if they're willing, you know, just because if I had extra money in my bank account, which I don't because I spent, you know, even more during the pandemic than I normally do. Right. Even if I did, I still wouldn't be willing to pay whatever price I had to. I'm still going to make decisions based on what I think something's worth.
Right, but if they're small, very incremental, Matt, maybe you don't even notice and maybe you're okay with it.
I can be fooled just as much as the next guy, Danny. Coming up, Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean, talks to us about the Delta variant.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold in economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Markets with the First Word News. I'm Leanne Gerrans. Saudi Arabia and the United Arab Emirates have ramped up their tension in their OPEC standoff. That has left the global economy guessing how much oil it will get next month. The Saudis want OPEC and its allies to increase production over the next few months and also extend its broader agreement to the end of next year. The UAE wants a short-term deal. Now, China has expanded a cybersecurity probe beyond the ride-hailing giant Didi. The government is now investigating 2 other Chinese companies that went public in the U.S. in recent weeks, Full Truck Alliance and Canjong. Authorities want to tighten their control over internet data in the interests of national security. Now, the Vatican says Pope Francis is in good condition a day after he underwent surgery to remove half of his colon. A spokesman said the Pope was alert and breathing on his own. He is expected to be hospitalized in Rome for about 7 days. And Apple is ramping up its efforts to decentralize out of Silicon Valley. The company has been losing talent who have said they cannot afford the high cost of the San Francisco Bay Area. Apple is spending almost $2 billion on new campuses in Texas and North Carolina. It is also hiring engineers in Canada, Germany, New Zealand, Spain, and here in the UK. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Matt.
Leanne, thank you very much. Leanne Gerrans there with your First Word News. Now, President Biden took to the South Lawn of the White House yesterday to speak in celebration of the 4th of July, Independence Day, as we call it. I'm not sure if it's called that in the UK. He hailed the U.S. vaccination program and efforts to control the pandemic.
We never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation. And it's within our power to make sure it never does again.
Joining us now is Dr. Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean. And certainly some kind of victory lap, Doc, has to be granted to the president. He has done an incredibly fantastic job of rolling out all of the vaccines that the previous administration, gathered up. But is there still a lot more work to be done?
Well, there certainly is some more work to be done. I do think it is appropriate, given how painful the last, year and a half has been, for the president to, stop everyone and say, look how much we've accomplished. Look how we've gotten control of our lives back. And together we can finish off the job that we started. I think that is a great message right now. But it is still true that many people are not vaccinated. And with the Delta variant spreading, people who are not vaccinated remain at pretty significant risk. And this is a moment to keep going. Last week I went out and vaccinated with the city health department in Baltimore, and it was at a library branch, and a number of people wandered in and said they've been wanting to get vaccinated, but they couldn't find a convenient place. They couldn't get across town to the mass vaccination site. Some of those people at very high risk. So I think the vaccine campaign still has a ways to go.
On that note, we do have LA strongly recommending people wear masks indoors now, given the spread of the Delta variant. With that, does our calculation need to change about mask wearing because of the spread and potential cropping up of these variants?
Well, I think that it is quite possible, particularly in parts of the country where the vaccination rate is low, that there will be a surge in cases. And when that happens, it's more likely, if you're in a supermarket, that you'll bump into somebody who is contagious. And if that's the case, wearing a mask is a not unreasonable thing to do, because as we know, these vaccines are not 100%. There's a small chance, and in an enclosed environment with somebody, who is infectious, that's going to maximize the chance you'll get sick. So I do think we can predict that in certain areas, it's going to be a reasonable thing to do for people to wear masks indoors. And it may also be at certain times. I think that may be not just for COVID, but also for flu. Masks are so effective that certain times of the year it may make sense in indoor environments to sometimes be wearing masks.
I could understand saying you have a choice. You can decide whether or not you want to wear a mask, but especially in cities like New York and Los Angeles, where everyone is vaccinated who wants to be vaccinated, right? I mean, not only can you get your vaccination at any local doctor, but they'll send someone to your apartment to vaccinate you. And in that case, the Delta variant isn't very likely to get you terribly sick, is it?
Well, I mean, what do you say to somebody who has cancer, somebody whose immune system's not responding to the virus? You know, I think it's more challenging in that situation. And the Delta variant is less likely to get you sick if you're vaccinated, but it's not impossible, particularly for older adults. So I think that it really is a judgment call as the number of cases go up. When it's a very low number of cases in the community, it's probably an overreaction to mandate masks. But as the number of cases go up and the chances people are going to consistently bump into people who are infected increase, then those are the kinds of policies that should be considered.
Dr. Sharfstein, so you say it's a judgment call. I think to what's happening in the UK, where I am right now, and you have more talk from politicians saying, okay, we're going to start to ease some of the restrictions. It's going to become a personal choice, you know, whether you socially distance or wear a mask. Is that the right approach when it comes to judgment, or is it kind of you need to look at where the clusters are, and that's where you have these restrictions?
Well, I think that it is really important for people to take action for themselves, and there's a lot in our health that is a personal choice. And then when the risk gets so big, that's when it's appropriate for public health measures to be considered. So, you know, people make all kinds of decisions for themselves about when they're going to drive, where they're going to drive, but you know, you can't go through a red light. You have red lights, you have seatbelt laws. There are things that are in place because the risks are just so high. And what I'm saying is that we don't know what's going to happen in the United States with the Delta variant, but there may be places where the hospitals fill up with patients and where, you know, there are just so many cases that it's very likely that people will be bumping into them. In that case, a reasonable public health measure is something that should be contemplated.
All right, Doc, thanks very much. Always appreciate your insight and your time. Dr. Joshua Sharfstein is the Vice Dean at the Johns Hopkins Bloomberg School of Public Health. Of course, Michael Bloomberg is also the owner of this network and Bloomberg News. Coming up, more Bloomberg Markets with myself and Danny Berger. We'll be with you for a couple hours longer. This is Bloomberg.
A bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, you know, those things you have to be mindful about that. But I think it's incredible what's been achieved so far. But, you know, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
From Berlin to our audience worldwide, welcome to Bloomberg Markets. We also have Danny Berger with us in London as well. Here are today's top stories for you. Crude showdown, Saudi Arabia and the UAE ramping up tensions over output. Also, President Biden is declaring America's independence from the coronavirus pandemic, and Chinese tech stocks selling off as Beijing strengthens its grip on cybersecurity. Good morning, everyone. It's Monday, July 5th. Of course, a holiday in the U.S. I'm Matt Miller here in Berlin. Danny Berger joining us from London. And Danny, we do see markets trading outside of the U.S., and we do see some really important geopolitical issues that are moving prices.
Yeah, we definitely do. And OPEC, I would seem to believe, is what you're kind of hinting towards as being really the big one here, right? And it's been so fascinating, Matt, hasn't been, to watch this debate happen publicly, not just publicly, but here on Bloomberg TV, between OPEC finance ministers, energy ministers rather. But in Europe, here is the picture. It's also making a difference in Europe, I have to say, because in that stock 600, that's up 0.1%. It really is UK energy, basic resources that's helping to lift us further here. So you can see the UK outperforming there, up 0.3%. We also have a possible deal of a private equity company. 3 are bidding at the moment for Morrison. SocGen says maybe Amazon will want to bid for that UK grocery store as well. We do have a German 10-year bond yield that is moving higher, so a little bit of selling in there as well. Let's go ahead and roll it over and see what our next board is too. We have our Asian data. One of the remarkable things here is looking at what happens in China. So we get China cracking down on Didi, the ride-hailing app, and part of one of many moves of China looking at big tech, cracking down on data collection. Still, Chinese equities end the day higher. Despite that, we also had tech ending the day higher. But if you look everywhere else in Europe, a pretty negative session. You had the Hang Seng down 0.6%. In Japan, equities doing a similar thing as well, and some softness in the dollar versus the yen. So, Matt, I mean, a lot of geopolitical cross currents, and because it's July 5th, I mean, none of them are really American stories, are there? You have OPEC, and you have China as well. So markets still giving us some volatility, perhaps, even though it is a lighter volume day.
We do have the victory lap by President Biden. Some people are questioning whether that's a little bit premature, and we'll get into that as well as we talk about the spread of the Delta variant, especially across the U.S., in the South and in the middle and flyover country where I'm from. Right now, though, let's talk about the U.S. jobs report. Payrolls climbing by the most in 10 months amid new signs that the economic recovery is picking up steam.
850,000 job gain in 1 month is a really good number, good solid number.
For every positive thing you point to, there's something less positive.
I'm a bit more enthusiastic about this data. Yes, I think there's, as Mohammed does, there's some mixed points to this. I just think you have to step back and put some perspective, though.
We've seen more people looking for work. We've seen growth in hospitality, leisure, restaurants. So it shows that President Biden's economic plan certainly is working.
It is mixed, which means that the Fed will look at this and say it confirms a wait and see approach.
It could add even more if there wasn't this constraint on the growth in jobs at the moment, which is the labor shortage.
There's a little bit here for everybody. Of course, the household survey was also mixed and a bit weak. So I think Federal Reserve officials can kind of see what they want to see on this report.
Joining us now is Kit Jukes, SocGen Chief FX Strategist. And I want to get your take first, Kit, on the jobs report, what it means for the Fed. And, we thought we'd seen a pretty hawkish turn from the Fed, and yet rates were still moving down. Right now, I'm looking at a 10-year of not trading, obviously, but 142.38 seems incredibly low for a central bank whose members have been talking about tapering sooner than later and raising rates, maybe even at the end of next year.
I think the last bit was the bit that summarizes it, though, Matt. They're talking about raising rates. Some of them wanted it as the end of next year. They moved, the majority of dots into the back end of 2023. It's the 5th of July, 2021 at the moment. So no one's talking about raising rates within 12 months. The market prices a rate cycle after the bond sell-off in the first quarter of the year. And it prices a rate sell-off towards, give or take 2% at some point in the future. And what we want to know is, when's it going to start? How far is it going to go? I don't think we learned that from the Fed. I think, or at least we didn't learn enough to make more people jump at the idea of going short 10-year notes and paying the negative carry away, or short any part of the curve and paying the carry away. Because although the yields and rates are low, the front end is still even lower. And that I think is kind of what matters now. So we didn't learn much in terms of that, and we opened ourselves up to see more of the debate between regional Fed presidents and Richard Clarida, Jay Powell, and John Williams when we see the minutes on Wednesday. And then we just move on and on to the next piece of data. The JOLTS number this week on job openings will be a bigger deal than it's been for a while to give us an idea about how much tightness there is in the labor market. But we don't quite have the ingredients for the next stage. So we're hypersensitive to all of these numbers, and I'm not sure what to do with them when we get them.
Well, given the lack of ingredients, I still wonder what your expectation is for an economic recovery right now, and how that influences your year-end or 12-month, 10-year target.
Look, I think that part of the problem for me is I find it easier to think where markets are 2 years down the road than where they are 3 or 6 months down the road, which is a really useless thing to be able to figure out in your head. But there's no reason to think this recovery in the States is anything other than very strong. It's going to run into some speed bumps along the way, but this is a much better economic recovery than we could have hoped 12 months ago. And at some point next year, the Fed's going to hike. I don't know how high the Fed's going to get, but as that happens, I think inevitably you'll get higher 10-year note yields. They'll move up through 2% towards 2.5% in due course, and we'll probably end up with a lower high in yields, a lower high in Fed funds than we had in the last cycle. But that's not far enough away for you to turn around here this early and say, I'm going to put everything on bearish trades aggressively in the bond market without question. And it makes it easier for me to say, I think the dollar will be a good bit stronger in 2 years' time, quite a lot stronger in 2 years' time. But all I can do between now and the end of the year, potentially, is contrast the positive global trend if the Delta variant, for example, doesn't slow economic recovery down around the rest of the world, and at the same time look at a treasury market that continues to say, yeah, somewhere out there in the dim and distant future, the Fed's hiking rates. Great. How does that help me?
Yeah. Yeah, Kit, I remember back in May, you essentially said, look, the taper tantrum has already happened in the bond market. Is that still your view now? I mean, is it still your view that that was where the drama lay and we won't get any sort of big reaction in the bond market from here on out?
Yeah, I think there are two questions. Well, we can get big reactions. So I think the taper tantrums happen. Now the debate is about when the Fed starts raising rates and what makes you change from a view that this rate cycle won't see a higher peak than the last one, as a sort of an opening best guess. Now, inflation is what can make that change, proper, lasting inflationary pressures, and that could yet happen quite easily. But where we are now with that first rate hike, which the Fed has really focused us on, happening potentially in under 18 months' time, but not in 12 months' time. I think we focus on it a lot and we move the markets around a lot, but I'm not quite sure how we get our arms around something properly that's that far away. We just change our minds every few days, and I don't know how fast the rise in yields can be under that scenario.
What about the dollar? I mean, is there any element of surprise that we haven't seen a weaker dollar given, the recovery that's at hand in the U.S.?
I think the question for the dollar is a fight between expectations on what the Fed does on the one hand and global recovery on the other hand. I had a really long conversation with a client this morning who said, can you contrast and compare what's happening now with 2004 onwards when, the Fed was hiking, they raised rates before the ECB, for example, but the global economic recovery gave us this weakening trend for the dollar the whole way through that period, as currencies like the Australian dollar, the Canadian dollar, all the commodity-sensitive currencies got really strong. And what's the difference now was part of his question. I think today one of the differences is we're not sure where we stand on emerging market economic recoveries right now because they're behind, many of them a long way behind on vaccination, although vaccine distribution is speeding up a lot globally. And so you've got a sort of tricky fight. And I think in a sense, the difficult piece is with the Fed move so far out, it may be that the rest of the world is more important for what happens next to the dollar than Fed policy just for now, because we talk about it all the time, but maybe just nothing's going to happen much. Whereas bigger things could happen. And we saw, the people who hike rates in Mexico, a surprise rate hike has much more impact on global foreign exchange markets than it would at other times, because that's where the uncertainty lies.
All right, Kit, thanks so much for joining us. Pleasure having you with us. Kit Jukes there talking to us about what to expect in terms of rates, in terms of the Fed, and in terms of the economy as well. Of course, head of FX there at SocGen. Now let's get a look at what's ahead for the rest of the week. Another big week for economic data and for global central banks as well. You heard Kit just mentioning the minutes. For more, let's bring in Bloomberg's Emma Chandra. Emma?
Thanks very much, Matt. Yes, you're right. It is a big week for global central banks. And of course, exactly as Kit was just discussing, then of course we get a rate decision from Australia tomorrow. And of course, we are all looking ahead to those minutes from the Federal Reserve due on Wednesday after that big jobs report on last Friday. And of course, we'll also get minutes from the ECB. That's coming out on Thursday as well. And actually, if you want to take the conversation, which will be very much about inflation this week and where it's headed, the ECB, we're starting to see some disagreements there between members on how far or how hot they should let inflation run. And of course, on Friday, we'll get the UK GDP figures. That's also when G20 ministers are going to be meeting in Europe. But those UK GDP figures will also help us focus on the direction of the economy right here in the UK.
All right, excellent wrap there, Emma. Thanks very much for that. In fact, Kit is still here, and he's going to stay with us as well. Why don't I just get your quick take on what to expect from the G20 in Venice, aside from the fact that, Kit, it has to be an absolute dream to visit Venice without tourists. What do you think they're going to accomplish? No, actually, we have lost Kit. I'm sorry, my bad.
Flown to Venice.
You may not have heard the click, but he's gone. When he comes back, we'll ask him about Venice. No cruise ships, Danny, no cruise ships in Venice. So it's the perfect time to visit, and I hope the cruise ships will never be back. When we come back, we'll get more from Kit. We'll talk about the division within OPEC as well. That's still important. It's going to be incredibly important for oil prices. Obviously, tensions are rising there, the standoff holding at least two distinct possibilities for the oil market. I actually have thought of a third possibility that we'll talk about as well. That conversation coming up next. The thing is, they could make an agreement now. They could also, you could see OPEC unravel. It's terribly unlikely. We heard from Jeff Curry earlier from Goldman Sachs, but it's a possibility. They could also just buckle down and raise or lower, reevaluate everyone's baseline in OPEC, which would satisfy, you'd have to think, the UAE, but also the others. It would take a long time, but that conversation is coming up next. This is Bloomberg.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Markets with the First Word News. I'm Leanne Gerrans. President Joe Biden has all but announced an end to the pandemic in the US. He celebrated what he called a heroic vaccination campaign on the country's Independence Day holiday. The president missed his goal of having at least 70% of adults in the US getting at least one dose of the vaccine. The total is now at 67%. In South Florida, demolition crews have used explosives to bring down the damaged remaining portion of the collapsed condo building. Authorities say they needed to do this so rescue workers searching for victims could gain access to new areas of the rubble. So far, the remains of 24 people have been recovered. 121 others remain missing. Shares of British grocer Morrison's have jumped today. Apollo Global Management said is now considering whether to make an offer. Over the weekend, Morrison did agree to an $8.7 billion bid from a consortium led by Fortress Investment Group. Earlier, the company had rejected an offer from private equity firm CD&R. Now, the global economy is now left to guess at how much oil it will get next month. That is because the OPEC standoff between Saudi Arabia and the United Arab Emirates hasn't been resolved yet. The Saudis want OPEC and its allies to increase production over the next few months and also extend a broader agreement to the end of next year. The UAE wants only a short-term deal. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne Gerrans, thank you so very much. Now, let's turn to tensions between Saudi Arabia and the UAE, which at the moment are threatening to unravel OPEC negotiations. Saudi Energy Minister Prince Abdulaziz bin Salman weighed in an exclusive Bloomberg interview.
I would emphasize that it is the whole group versus one country, which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We will continue with it. The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participant in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well, it's your chance to have another maybe interview with me tomorrow or after tomorrow. It depends on how we will finish.
Are you worried we could see a massive spike in prices because the market is in need of more supply for the month of August?
If some people would like to have that, they can do that. Is it our intent? No. Because if it is our intent, why would we do the proposal? And why we would work with our colleagues? It's been a 2-month affair.
If you're on board with the proposal, Russia and the rest of OPEC is, and there's just one holdout, and that's the UAE, will you continue to increase by 400,000 barrels a day without the UAE on board?
We cannot. Because it's an agreement that is done by consensus.
So does this dispute have the potential to bring an end to OPEC Plus?
Why should it do? If we have 20 countries are in agreement, why should it do? Can I give you a sequel? Remember that other sequel? In March, we did not have an agreement, but the situation dictated that people can sit back, talk about seriously how to attend the situation. It's very simple.
But OPEC Plus needs a consensus or it cannot work. So if the UAE does not sign up, you say there will not be an agreement. But you also are saying that this dispute cannot mean the end to OPEC Plus. Does this mean potentially we could see an exit by the United Arab Emirates?
what's peculiar for all of us is why they don't. They've never brought that complaint before, even after signing or before signing the April agreement. They've never brought to that complaint. They've never dug their feet on an issue like this ever since. Why now? Why now? It's an extension of not of 8 years or it's an extension of 8 months, and there is a solid logic behind it, as I explained, and as it has been accepted by everybody.
There's Anne-Marie Horder talking with the Saudi energy minister, rather. And Matt, I mean, I come back to this idea that it's really fascinating that they're having this debate in public, right? I feel like it must bode poorly for what's happening behind closed doors if the way that they air this out is by coming on and speaking publicly to markets right now.
Yeah, it is actually very weird, especially considering the fact that the Saudis and the Emirates are typically more friendly, the UAE and Saudi Arabia on good terms. So it makes you wonder what's happening. Apparently they haven't spoken to each other personally, at least that's in the most recent Bloomberg News reporting, although of course their staffs are probably talking to each other behind the scenes. To me, it seems like the risks are pretty asymmetric for the price, right? Because if they do have an agreement and they boost 400,000 barrels a day, that's not a huge boost. So it's not terribly bearish for the price. Maybe it's bullish for the price if they extend their current production limits to the end of 2022, but not incredibly bullish. If OPEC unravels, which I know people have said is extremely unlikely, but if they do, that's very bearish for the price. So I think the downside risk is a lot more than upside.
Right, and I mean, it is just such a tight market right now, and a market that's really nervous. I mean, looking at the time spreads on Brent and WTI, you get this sense that the market is more or less coiled, but Matt, it feels coiled, ready to spring higher. I mean, we're looking at WTI above 75. We're also looking at Brent above $76 a barrel. So that's a market that sees perhaps things moving higher. So yeah, the risks are asymmetric if it is one that goes lower, Matt.
Yeah, absolutely. We'll continue to talk about that. Plus, House Democrats are setting a baseline for talks, passing a $715 billion infrastructure bill. We'll talk about what's going on in Washington next with Terry Haynes of Pangea Policy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives, it no longer paralyzes our nation, and it's within our power to make sure it never does again.
This is Bloomberg Markets. I'm Matt Miller in Berlin with Danny Berger in London. And of course, that was President Biden there declaring independence from the pandemic and preparing to hit the road, promoting his spending bill with infrastructure talks starting to slow down. Terry Haynes, founder of Pangea Policy, joins us now to discuss. And Terry, you know, the Biden administration made a lot of headway last week and then promptly took a step back by, I guess, threatening to veto the bipartisan bill if they didn't get everything else they wanted in a reconciliation bill. Has that all been smoothed over now? Is everybody back to bipartisan joy?
The bottom line here is that the Biden and his folks made what could charitably be called an unforced error. I think they've rectified that problem. It's for some time been positive, non-consensus positive on infrastructure happening. Even after that last little kerfuffle, I'll keep it at about 80% that it happens. But the risk for markets here is that infrastructure is one part of a four-part dance, not just the infrastructure bill, but also the so-called families package, which could add up to between $2 and $6 trillion additional dollars to U.S. spending, including climate. And if you take those two and add on the annual spending bills, which happened at the end of September, and the fact that Congress has to extend or suspend the debt limit, debt ceiling to allow the government to borrow, what you've got is a situation where a lot of trains have the potential to collide in the early fall, and Congress will only be in session 1 out of the next 3 months. So it's likely that what happens is that we get greater uncertainty through the summer. When we come back in the fall, there will still be more uncertainty, and then what happens is, you're going to have this four-part dance going on. I think that what falls away is the family's climate package, which I give at only 30%, but the rest of it happens ultimately.
So how does the rest of it happen? I mean, don't they just push through what they want with reconciliation anyway?
No, it's not that simple. You've got a situation where not even 50 Democrats in the Senate, much less the 4-seat majority, 5-seat majority that exists in the House, are not going to come together around some of the more lavish proposals. Senator Manchin of West Virginia, a swing Democrat, has said that he's only going to go for as much as $2 trillion in the families package, which leaves a lot of Democratic progressives really not happy about that. There's a large fight going on in the Democratic Party right now that's pretty much open for everybody to see, and that fight's going to take a little while to resolve. And while it plays out, I think you're going to have progress on infrastructure, and you have this natural deadline of the end of September, the end of the fiscal year, for spending and probably for the debt ceiling as well.
Terry, what happens if this accelerates the rift between some of the left? If you pass infrastructure, you don't get some of the family first. I mean, what happens down the road when taxes, for example, are on the agenda? What does this rift mean for that?
Well, I think that's a very good question, Danny, and thank you for it. What that means is that the likelihood of tax increases in the United States, I think, is substantially less than 50% today. The infrastructure bill is, as everyone knows, about $1 trillion to $1.2 trillion, about $600 billion in new spending. There are a variety of things that are being put in place to pay for that. But beyond that, what you're going to have is you're going to have the annual spending bill, the debt limit, which increases borrowing. That's all going to happen. But the tax increases were really only ever going to happen with this so-called families package that includes the climate wish list. And that, since that is not likely to happen, I think the tax increases also are not likely to happen. So what you've got here is a summer into fall that has a lot of political risk attached to it, but ultimately you've got a pretty market positive result in the sense that the things that the markets want to see are going to happen, and the tax increases are not likely to at this point.
Terry, which tax increases are you talking about there? You mean the capital gains tax increases?
Well, yeah, the vast majority, I think all of what's been proposed in the families package is going to include proposals on tax increases of all kinds. And that's been part of certainly the progressive Democratic platform for quite some time. The Biden people have talked about that, but I think what's happening is you've got bipartisan agreement about the other things I've talked about. But so far, all you've got progressive Democrats agreeing that what they want is a huge ramp up in spending on the other stuff, but at the same time, they don't have support from centrist Democrats like Manchin, who I suggested, and they certainly don't have support from Republicans. So they're going to have a very hard time with that.
Does that extend to the global minimum tax as well that the G20 is discussing in Venice? Is that going to be a difficult thing to get through as well?
I think that I pegged that last week at only about 30% likely to happen, frankly, because it also has to be one of the tax proposals that's part of the families package. I don't see a very closely divided Congress passing something like that, frankly. I don't think, in no small part, because neither politicians nor markets look at that and think that it's some sort of ceiling. They understand that it's some sort of floor. So there's market negative consequences potentially there as well. But I think politically, raising taxes like that and imposing a minimum tax, most of Washington sees as a political loser. I don't see it likely this year, certainly.
Terry, you're going to stick around with us. Thanks so much. That's Terry Haynes. Now, though, let's get over the first word news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Saudi Arabia and the United Arab Emirates have ramped up their tensions in their standoff against OPEC. That has left the global economy guessing how much oil it will get next month. The Saudis want OPEC and its allies to increase production over the next few months and also extend its broader agreement to the end of next year. The UAE wants a short-term deal. Now, China has expanded a cybersecurity probe beyond the ride-hailing giant Didi. The government is now investigating 2 other Chinese companies that went public in the U.S. in recent weeks, Full Truck Alliance and Canjun. Authorities want to tighten their control over internet data in the interests of national security. The Vatican says Pope Francis is in good condition a day after he underwent surgery to remove half of his colon. A spokesman said the Pope was alert and breathing on his own. He is expected to be hospitalized in Rome for about 7 days. And Apple is ramping up its efforts to decentralize out of Silicon Valley. The company has been losing talent who have said they cannot afford the high cost of the San Francisco Bay Area. Apple is spending almost $2 billion on new campuses in Texas and North Carolina. It is also hiring engineers in Canada, Germany, New Zealand, Spain, and here in the UK. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Matt.
Leanne, thank you very much. Leanne Gerrans there with your First Word News. Now, Terry Haynes of Pangea Policy is still with us. Terry, let's get back to the tax increases, because I think this is the most interesting aspect of it. You think that the Biden administration is going to have a very difficult time pushing any of the tax increases through. What happens then with the amount of revenue that the U.S. government is able to pull in?
Well, I think what's been shown is that revenue has been up in the federal government and the state governments despite the pandemic. I would expect that trend to continue, frankly, for at least a little while longer. But there's absolutely no doubt that the political situation I described, one in which the spending, I think, will continue in the next fiscal year largely flat as it has in the past decade, let's say. I think the United States government ultimately comes up with a debt limit, debt ceiling extension or suspension that allows continued borrowing. That's absolutely fundamental, of course, but there will be a lot of political angst and wrangling about that in September or so. And I think the infrastructure bill is something that, as I say, has about $600 billion in new spending, according to your reporting and others, and that's something that that ends up getting paid for. So all that is largely steady state. But what you have is a situation where a lot of these additional new proposals aren't going to pass, and since the tax increases are hooked on to those more lavish proposals, I think they ultimately fail as well. So I don't think you get an additional dent in the United States government position.
Terry, given all that, when we finally get back to the debt ceiling conversation, is what we can expect the Republicans attacking deficit spending? Is that going to be a big focus over the next few months?
Yes, the political attacks will certainly feature. What has happened over the past decade plus is that anytime the party out of power wants to be critical, one thing it criticizes is the additional fiscal spending or tax changes of the other party. Democrats certainly did this with Republicans in 2017. Republicans did it during the Obama administration. I would absolutely look for Republicans to criticize Democrats for profligate spending at the same time that that Republicans will say more fiscal discipline is needed. And they'll frankly point to centrist Democrats like Senator Manchin, who is saying the same thing while also saying, I can accept $2 trillion in additional spending on the families package. So it will be the usual fraught debate that has a lot of political risk attached to it. I think in the end that nobody wants to stop the U.S. government from borrowing, and I think that the debt ceiling and spending both ultimately get passed. But as I say, that's 3 months away, and infrastructure to some extent will be hostage to that debate.
It did feel like some of that fiscal discipline maybe was put off to the side a little bit in the beginning of the COVID pandemic because we needed that spending to ramp up the economy. Maybe I'm just being over-optimistic, but do things like climate change, the building collapse in Miami, does that fuel the conversation too? Fast here, Terry.
Another good question, and I think it doesn't change very much. Whatever else the Surfside collapse is or was. It's seen as a local and state problem by and large. Climate is seen as certainly as a legitimate issue in Washington, to say the least. But what ends up happening is that the ability to want to pay for every
paying for it's always the problem. Terry, got to wrap you there. Unfortunately, not enough time. Terry Haynes of Pangea Policy. Thanks very much for joining.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg Markets. I'm Matt Miller in Berlin with Danny Berger in London. Now, China is expanding its latest crackdown on big tech, tightening its grip on data.
Xi Jinping has really set China on a pretty predictable and firm path. It's about growing wealth, growing power, both economic power and military power and technological power.
That extraordinarily striking line, which will no doubt be in every headline tomorrow, of Xi saying, if you bully China, you're on a collision course with a steel wall forged by 1.4 billion Chinese people. The number of applause lines here that were provoked by calls to nationalism, strength, sovereignty was really, really quite striking.
Looking at a broader quality exposure, looking at these high quality names across sectors will give you that much needed cyclical exposure. And I think that is where China is quite uniquely positioned, because in most of the other regions, value and quality are actually moving opposite to each other.
Terry Haynes of Pangea Policy is still with us. And Terry, I want to just get your take on this. I think it's pretty fascinating that China doesn't want foreign investors owning chunks of companies that have massive amounts of consumer data. I guess the U.S. wouldn't love it either, but it is that way for U.S. companies. So what's your take on this on China's sort of clampdown on this?
Well, there is an irony there, as you point out, and I'll leave that on the table. Beyond that, there's an increasingly worrying and public trend here that every time a Chinese company goes for an IPO, makes a bigger splash in the Western markets. And I'm thinking, of course, of Alibaba and Ant Group, as well as Didi now. They get a little bit out over their skis, and all of a sudden they're hit with regulatory problems and all the rest. And I wonder whether Chinese authorities understand the message they're sending. I assume they do. And if so, what the message is that it is, difficult to do business with Chinese companies, and it's difficult for Chinese companies to break out into non-Chinese public markets. And those, if you're a rest of the world investor, ex-China, that's not a good signal to be getting right now.
Well, certainly the U.S. IPO market is going to be interesting to watch to see how that shakes out when it comes to to Chinese companies rather. Terry, thank you so much for joining us on this Monday. That's Terry Haynes, Pangea Policy founder. Let's also bring in Patrick Armstrong of Plurimi Wealth to get the view on what's happening here as well. Patrick, thank you for joining us. When you look at the moves that China is making against tech, specifically U.S. listed tech, does this bring into the fore geopolitical concerns again? Do investors need to be pricing this in?
It's something you've got to be aware of. It's been going on for years, I suppose, with the U.S. and what it's done with Huawei, and you've seen with Alibaba with their IPO and Didi now. It's something you've got to be wary of. It's something that I don't think is going to change, but I don't think it's got an overarching real risk to the macro backdrop and risk to equities as a whole, but on more stock-specific issuances. I don't think you'd want to be clamoring into any basically Chinese domiciled company looking to IPO in the United States right now.
I mean, besides the individual stock story, when it comes to the overall market, I mean, Patrick, it really just feels like nothing can derail it, which probably is a dangerous feeling. But I was just looking at some Bank of America data that equity fund flow at the current pace this year will be greater inflows than the past 20 years combined, which is just absolutely mind-melting. I mean, is this the point where you want to be concerned that it feels like it can continue on regardless of everything that's happening?
Yeah, what we keep coming back to is I look at the multiples, and I'm a value investor at heart, and the MSCI world's never been more expensive than it is today on price to sales, on enterprise value to EBITDA. But we're sticking with equity positions as long as the three pillars are there that are driving equity growth, and that's massive liquidity, negative real yields, meaning that inflation expectations are higher than treasury yields, and they're going to stay that way for the foreseeable future. And earnings growth is going to be strong. So I think as long as all those three forces remain in place, the path of least resistance is higher for equities, despite the fact they are at very expensive multiples.
There's been a lot of talk about the growth value rotation. Although the lines are a little bit murkier, Patrick, what are your favorite value plays right now?
That's really, I think, why I'm comfortable in equities, that the MSCI world's trading at 20 times forecast earnings. The equities I'm holding are trading at about 14 times forecast earnings, and I've really pushed the equities to stocks that are benefiting from outsized cash flow right now, that the consensus view is that those cash flows will fall off a cliff. So ArcelorMittal is trading at 5 times earnings. Infrastructure spending is going to increase in the United States. It's going to increase around the world. I think those earnings are a little bit longer lasting than consensus expects. Maersk, shipping companies, freight rates are incredibly high. It's trading at 4.5 times cash flow. And all the manufacturing that's coming back on stream, demand is strong. I think freight rates probably stay higher for longer as well. Moderna, another one, the vaccines, we're going to have booster shots for the next decade. So I'm buying companies that are cheap based on a consensus view that those earnings are going to deteriorate rather quickly. And I actually think we're in a reflation for longer type trade. And you can pick up companies that aren't all-time highs on multiples.
Moderna looks like one of the growthiest stocks that you hold, Patrick. And of course, people have hope that mRNA can do a lot more than just make a COVID vaccine. Are you in that camp?
I think so. I'm not a doctor or a biochemist by any means, but I take comfort from what the CEO is telling us. It's got applications, and I think it's going to come out with a better influenza vaccine, and a lot of applications on cancer, hopeful for there. I actually think Moderna, priced at $230 a share, is fairly discounting, basically booster shots for the next decade, but there's still a lot of call options on the other technologies that the mRNA can work in many other areas. So I do think it's something you're getting paid for on what's there, but there's a lot of upside potential.
Patrick, quickly here, what do you make of a VIX that continues to knock on all-time lows, but a skew index of that tail risk that continues to go to all-time highs? What gives for the dichotomy between the two?
Yeah, I think because central bank liquidity and zero interest rates and buying bonds, all of that suppresses volatility. But I think the market is aware that markets are trading at record high multiples. So there's above normal chance of an outside risk. So that's a high skew. So at the money options for put options for August right now on the S&P 500 are trading with an implied vol of 12. And if you go 10% out of the money, those vols are implied at 19%. So it's most likely you get a slow grind up, but anytime you're at record multiples, there's the chance for the outsized downside, and I think that's what the skew is showing.
Patrick, always great.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have been
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
The curtain will rise again.
Broadway's returning June. Have you bought tickets? It's busted out. You've got more time here. Have you Commodities are up.
Keep going.
To the moon. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off? So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
From Berlin, for our audience worldwide, welcome to Bloomberg Markets. Here are today's top stories. Crude showdown. Saudi Arabia and the UAE ramping up tensions over an agreement. President Biden declares America's independence from the coronavirus pandemic, and Chinese tech stocks sell off as Beijing strengthens its grip on data. Now we begin with the U.S. jobs report. Payrolls climbing by the most in 10 months amid new signs that the economic recovery is picking up steam.
850,000 job gain in 1 month is a really good number, good solid number.
For every positive thing you point to, there's something less positive.
I'm a bit more enthusiastic about this data. Yes, I think there's, as Mohammed says, there's some mixed points to this. I just think you have to step back and put some perspective, though.
We've seen more people looking for work. We've seen growth in hospitality, leisure, restaurants. So it shows that President Biden's economic plan certainly is working.
It is mixed, which means that the Fed will look at this and say it confirms a wait and see approach.
It could add even more if there wasn't this constraint on the growth in jobs at the moment, which is the labor shortage.
There's a little bit here for everybody. Of course, the household survey was also mixed and a bit weak. So I think Federal Reserve officials can kind of see what they want to see on this report.
Joining us now is Lothar Mentel of Taton Asset Management to talk about what we saw in that report, what it's going to do for the Fed, and really what it means for the economy. Lothar, first off, the economy, the economic recovery, is it going to continue with this kind of strength into the second half?
Well, let's hope so. There are a few things that are currently clouds on the horizon, and here in the UK, we're showing what happens when you get hit by a variant of the virus that is spreading easier against a mostly vaccinated population, and that's going to hit Europe and the US in due course of the next couple of weeks. But from what we can see in the UK, it shouldn't really set the economy back too much, and everything seems to be well in train to go in the right direction.
Yeah, what we're seeing in the UK, I guess, is that although it spreads quickly, people are less likely to get very sick from the Delta variant because they've been vaccinated, and hospitals aren't overflowing, the deaths aren't rising from this. Does that mean fewer lockdowns across Europe, and that we won't be returning to that kind of thing in the US either?
Hopefully, but I think it's also a very good, interesting catalyst for some other things. So we've already seen in Portugal, which was the first one to be hit by the Delta, that vaccination rates are shooting through the roof. So it's a real catalyst, and has been a catalyst here in the UK as well, amongst communities that perhaps weren't so keen on getting vaccinated, and big catch up there. So that could be quite a positive element there. And so, yeah, just generally getting the health system up to speed, and everybody who has not yet had the vaccine to come forward. And that could be actually a positive arising out of this negative, although there's obviously also this cloud on the horizon that if this really starts to scare Europe, it could be really undermining yet another summer season for the Mediterranean holiday destinations, and that would be quite a negative. So there is a bit of a wait and see here.
It seems like, travel and leisure, you mentioned the Mediterranean, also sport must be a catalyst, right? If getting vaccinated makes it easier for you to watch the Euros, then I'm sure you're going to want to do that, even if England somehow manages to beat Germany. Wimbledon as well is going to be a huge one, right? They're going to be completely full. Are these kind of things going to bring the economic recovery really to the forefront of what we're watching?
Yeah, I think there's a huge demand amongst the public to really catch up with all the things that we haven't been able to do, and there seems to be not so much fear to actually get infected, particularly when you've been double vaccinated. Yes, everybody knows that it is possible, but everybody can also see now here in the UK that actually the likelihood that you get really, really unwell from it is probably at a similar level to what we would normally expect from a normal flu. And therefore, particularly the younger people don't seem to be particularly concerned, whereas the older people, I think, are a bit more cautious.
Goldman Sachs says England's going to bring the cup home. Do you think that's the case?
Well, if they continue to play as they have, and it looks very German to me how they're playing at the moment, then why not?
All right, we're going to talk about more serious stuff. Well, actually, is there more serious stuff than European football? I'm not sure. We're going to get back to the economy. We're going to get back to the markets with you in just a moment, Lothar. Right now, I want to get over to Emma Chandra for a look at what's going on the rest of the week. It's a big week for economic data. It's a big week for global central banks. Emma, what have you got?
Yes, you're absolutely right, Matt. Despite the holiday-shortened week, of course, given the July 4th holiday, which is happening today, July 5th, there is a lot to look forward to. First of all, of course, is the resumption of that OPEC meeting due to happen today. A lot of delays happen and clearly a lot of issues to work through there, and what that is doing to the oil price and the inflationary pressures we're seeing there, which also feeds into, of course, the global central bank news that you highlighted too. We've got a lot of that coming up. First of all, the Reserve Bank of Australia coming out. They've got a meeting tomorrow. They'll make an interest rate and a QE decision then too. The big event, of course, is the FOMC minutes. That's due out on Wednesday. There'll be a lot of people in the markets passing those, looking for any sign, of course, of any further hawkishness. The ECB minutes, they come out on Thursday too, so we continue that theme. And of course, we get some UK GDP figures on Friday. And of course, with that also feeds into that global inflation debate. Also on Friday, all eyes will be on Venice, of course, and that's because the G20 financial ministers will be meeting. We'll get some more information on that global tax deal from them. So that's certainly something to watch, not least, of course, for the gorgeous location. Speaking of gorgeous locations, also the Sun Valley Conference, that's happening this week too, and that'll be pretty interesting over in the US, largely, of course, because of who attends. We know that Jeff Bezos is supposed to be there, Tim Cook, Warren Buffett, a whole host of big names, and of course, a lot of people will be listening to hear what they have to say, not just about their companies, but also about the global economy and the global recovery from the pandemic. And Delta, that is another thing that we're watching. As you were discussing with your guest there, we'll get some news from the UK today. The UK government expected to confirm that it will go ahead with its full reopening plans on July the 19th. And of course, the biggest thing in the market, Matt, is of course that big semi-final match on Wednesday, which I will be watching very closely when England takes the football pitch once again.
Yeah, I mean, even I will be normally I would rather watch grass grow than a soccer game, but this has been fascinating ever since England,
football,
I think
Matthew,
ever since
football.
England beat Germany, I can't believe the Swiss were missing penalties like that to allow Spain to go through, and now, yes, football will be my focus as well. But Venice, I think, will be really interesting, Emma, because there are a few countries that are still against this global tax deal. What are the chances they're going to have to push even further past Friday?
Well, I think the chances of pushing further past Friday are still quite high. I think we're probably going to look at getting full confirmation, certainly from the full G20 later in the summer, if not into the autumn. That's what we're reading a lot about at the moment in terms of that tax deal. But of course, they're in a very strong position going into this Venice meeting on Friday, certainly from the headlines, of course, that crossed late last week on this. And there does seem to be a consensus forming, and that should, of course, lead to another, it would be considered a very big win, of course, for the Biden administration.
Yeah, you've got some neighbors, though, to the north that are not for it. Emma, Chandra, thanks very much for that, setting out the calendar for us for the week. Lothar Mentel of Taton Asset Management still with us, and Emma had quite a few central bank activities highlighted this week, not the least of which in Australia, but of course we also have the minutes coming out of the Fed, the jolt after the big jobs number that we had last week. Are we going to start seeing a more hawkish turn for central banks? Is this the turning point for global central banks, Lothar?
I think that turning point has already happened, and the markets were surprisingly benign in their reaction to it, because when we saw those dots plots move the other week, that really, to my mind, was the turning point. But what the markets, I think, have told us is that they also believe the central bankers when they're saying, no, we'll actually stay really easy for quite a while, and we'll let that inflation, which they call transitory, run, even if that means it goes a bit beyond what they would normally accept. So I think the important point here is that persists, and the central banks aren't going to budge from their narrative from before, because that's really, really important in the markets at the moment, that yields stay stable and we don't get an upset to the general recovery from the financial markets.
How do you juxtapose the inflation situation that we have here? I'm on the continent, you're in London, but here in Europe generally with what we're seeing in the US. I mean, Americans are worried about 3 and 4% that they're seeing now in the core, right? For the ECB, 2% would be a dream come true, and it's not likely to happen.
Yeah, well, the US is a bit advanced in the recovery compared to Europe, so I'm actually expecting similar things to happen here in Europe as well, and I can already see it in the pipeline with so many things just not being available because just of supply bottlenecks at the moment, and that pushes up prices, and that's what's happened in the US as well. But that's the thing that also then usually removes those supply bottlenecks unless they're structural, and we didn't see any structural supply issues before we went into the crisis, so there's little to suggest that that will happen now, hence why I'm definitely with the US Central Bank when they say this is transitory, and actually this price upwards push is probably going to mobilize the supplies that currently are being so much demanded by the consumers and by industry.
The one thing you got to watch for, I guess, especially in the case of the U.S., is wage increases. Do you expect to see that continue to come through, real wage inflation for the U.S. worker?
Yeah, well, and that seems to be one of the interests of the U.S. Central Bank as well. The Fed seems to want to see wages rise in order to get more demand into the consumer side. And yes, I think with where we are on the labor front, that is actually quite likely to continue. I don't necessarily think it's going to get out of hand, but certainly that rebalancing of capital versus labor seems to be something of late that central bankers are focusing a bit more on, perhaps to stabilize the political side.
Yeah, it's pretty interesting. Lothar, always appreciate talking to you. Thanks so much for joining us. You're going to stay with us for another block here on Bloomberg, so don't hang up. Lothar Mental is going to continue talking to us. We're going to cover the victory lap that President Biden has taken about the immunizations that have happened, independence, declaring independence from the pandemic. Infrastructure talks there as well continue in Washington. Maybe they look like they're stalling right now, but it does appear to be an issue that both Republicans and Democrats want to tackle. Roads and bridges crumbling, airports and ports need updates. Broadband coverage is still spotty over the richest country in the world. We're going to have that conversation next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Markets with the First Word News. I'm Laura Wright. President Joe Biden has all but announced an end to the pandemic in the U.S. He celebrated what he called a heroic vaccination campaign on the country's Independence Day holiday. The president missed his goal of having at least 70% of adults in the U.S. getting at least one dose of a vaccine, the total now at 67%. In South Florida, demolition crews have used explosives to bring down the damaged remaining portion of the collapsed condo building. Authorities say they need to do this so rescue workers searching for victims could gain access to new areas of the rubble. So far, the remains of 24 people have been recovered. 121 others remain missing. Shares of British grocer Morrisons have jumped today. Apollo Global Management says it is now considering whether to make an offer. Over the weekend, Morrison did agree to an $8.7 billion bid from a consortium led by Fortress Investment Group. Earlier, the company had rejected an offer from private equity firm CD&R. The global economy is now left to guess at how much oil it will get next month. That's because of the OPEC standoff between the Saudis and the UAE. That hasn't been resolved just yet. The Saudis want OPEC and its allies to increase production over the next few months and also extend a broader agreement to the end of next year. The UAE wants only a short-term deal. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Laura, thank you very much, Laura, right there with your first word news. Now, President Biden is declaring independence from the pandemic, preparing to hit the road, promoting his spending bill with infrastructure talks starting to stall.
We never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation. And it's within our power to make sure it never does again.
President Biden there talking about victory over the pandemic with the politician-sized grain of salt. It makes sense. Tatan's Lothar Mentel is still with us. Lothar, I guess the more important issue is the infrastructure bill. Not only does the U.S. need to fix its crumbling infrastructure, the spending has to be vital for the continuation of the recovery, or is the recovery already self-started and on its way?
Well, there are two parts of the recovery, aren't there? So there's initially the bounce back, and that has already happened to some extent in the US, the demob happiness of the consumer coming back, wanting to spend what they've saved. And that's almost an automatic recovery where governments don't really have to put that much more fiscal effort into it. But then to make that recovery sustained, that's really where we need the longer term investment. And that's where the fiscal side is very crucial, and just as crucial as the noises coming from the central banks of the next of coming month, because otherwise we might just fall back to that slow growth environment that we had before the pandemic struck, and that was certainly not something that seemed particularly sustainable. So yes, that infrastructure investment for the US, but also over here in Europe, those programs are really, really important because they could serve as the catalyst to make this bounce back into a recovery, and a sustained recovery running at a higher GDP growth level than what we had before we went into the pandemic. But if, as usual in the past, the fiscal side is way too slow and under-delivers compared to the original expectations, then it could also be a negative.
Yeah, I'm glad you bring that up. You know, when I tell Americans about infrastructure here in Germany, they find it hard to believe. They think all of the autobahns are smooth and perfect. The trains must run on time here. Everything is surely automated, and that couldn't be further from the truth. Are we going to see more spending in Germany, spending in Europe on things like infrastructure and broadband that's so desperately needed?
Yes, I do think we will see quite a bit more there. I think there's perhaps a little bit less catch-up in Germany to do than in some other nations. If I remember all the bridges that have been closed and are being refurbished and have been refurbished over the last 5 years rather than led to crumble, but there's still a lot of potential for catch-up elsewhere. But yeah, I think it's been a really positive to see the EU heads of state rally together and say, yes, we're going to do this. Yes, we're going to really raise money together, create that European bond market, that united bond market for once, and finally, and really address the challenges of the future. So that is really one of the big positives of the past. But, you know, we have to see whether they can actually really deliver on that promise.
I mean, if you step back and look at the EU, Lothar, what does it look like after Frau Merkel is done here? She's been such a strong leader. I mean, not just for the EU, really, for the G20. When I was there in Hamburg, she was applauded by all of the other world leaders as kind of the head of the group. Can that really happen if we have, another CDU leader or a Green leader in place? I mean, who's going to take charge?
Yeah, I think she'll be sorely missed. Her experience, her keeping things calm, and just really steering her colleagues through difficult waters. But let's not forget, those politicians that are going to step up aren't entirely inexperienced. I still don't expect that we'll have a Green chancellor, but far more likely that we'll have an Armin Laschet or an Olaf Scholz as the next chancellor. And they've got lots of experience, and they're also going to maintain that German stance of moderating things and steering things clear of the extremes. And let's not forget, elsewhere in Europe, things are also a lot more stable with Draghi in Italy, for example. I think that all bodes well for that transition phase to happen. But yeah, no, she'll be sorely missed.
What are the biggest headwinds to growth? What are the biggest headwinds to gains in these markets, Lothar?
I think it's still a lot of virus and pandemic and how we react to it. How will we go through this transition phase now of weaning off all the government support and going back to a full market economy, or at least as much market economy as we do have? That's going to be, a real challenge, I think, for the next couple of months. How is Europe and the US going to react to the rise of rates of infections? How we're going to get our heads around that perhaps now with the vaccinations we are safer, even though we still have very high rates of infection, but they're not affecting the healthcare system anywhere nearly as much as they did. So those things are all going to make this summer a little bit choppy, I think, because we know that equity markets have pretty much priced in what's going to come, and any setback in sentiment will be very negatively recorded. Let's not forget, at the moment, the PMIs that we're seeing everywhere around the world are really, really high.
Lothar, thanks so much for joining us. Lothar Mentel there. He is the CEO and founder of Taton Investment Management. Coming up, tensions rising over oil production agreements with divisions big at OPEC. This is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly. And later this week, we'll get unemployment, inflation, and retail sales data that should all further illuminate the economic recovery.
This is Bloomberg Markets. I'm Matt Miller in Berlin. Now, tensions between Saudi Arabia and the UAE are threatening OPEC negotiations. Here's Saudi Energy Minister Prince Abdulaziz bin Salman speaking exclusively to Bloomberg's Anne-Marie Horton.
I would emphasize that it is the whole group versus one country, which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We will continue with it. The agreement requires that we bring more production, yes, but to complete that honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put people, lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participant in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well, it's your chance to have another maybe interview with me tomorrow or after tomorrow. It depends on how we will finish.
Are you worried we could see a massive spike in prices because the market is in need of more supply for the month of August?
If some people would like to have that, they can do that. Is it our intent? No. Because if it is our intent, why would we do the proposal? And why we would work with our colleagues? It's been a 2-month affair.
If you're on board with the proposal, Russia and the rest of OPEC is, and there's just one holdout, and that's the UAE, will you continue to increase by 400,000 barrels a day without the UAE on board?
We cannot. Because it's an agreement that is done by consensus.
So does this dispute have the potential to bring an end to OPEC+?
Why should it do? If we have 20 countries are in agreement, why should it do? Can I give you a sequel? Remember that other sequel? In March, we did not have an agreement, but the situation dictated that people can sit back, talk about seriously how to attend the situation. It's very simple.
But OPEC Plus needs a consensus or it cannot work. So if the UAE does not sign up, you say there will not be an agreement. But you also are saying that this dispute cannot mean the end to OPEC Plus. Does this mean potentially we could see an exit by the United Arab Emirates?
What's peculiar for all of us is why they don't. They've never brought that complaint before, even after signing or before signing the April agreement. They've never brought to that complaint. They've never dug their feet on an issue like this ever since. Why now? Why now? It's an extension of not of 8 years or it's an extension of 8 months, and there is a solid logic behind it, as I explained, and as it has been accepted by everybody.
Great interview there, and hopefully Anne-Marie gets a sequel to that as well, as she was offered. Bloomberg's Will Kennedy joins us now. Actually, Will, I should say, hopefully they come to some kind of agreement, right? At least for markets, that's what we'd like to see, that either the UAE gets in line with production extension or OPEC grants the UAE some kind of solution. Could they come up with a Band-Aid and then try and deal with not only the UAE's base level, but also everyone else's?
OPEC normally reaches a compromise, Matt, as you suggest, but I think right now, as of this hour, it's looking quite far off. We're due to start talking again in 90 minutes. There doesn't, from what we gather, seem to have been any diplomatic progress in the last couple of days, and I think you see in those TV interviews that both the Prince and his Emirati counterpart, Suhail Mazrui, gave yesterday, that their positions are quite dug in. As to the compromise you suggest, that's the UAE's position, which is, look, everyone wants more oil, the market wants more oil, let's put more oil in the market this month and in subsequent months this year, but what we can't countenance is an extension of the deal beyond its original length of April 2022, and that's because the Emiratis insist that although they signed up to it, the baseline with which their production is set is unfair and requires them to carry a bigger burden than other producers in the OPEC Plus group. There's not much appetite to reopen that conversation among other members, because the plan that the Emiratis suggested would see some members, notably Russia, reduce their quota, and that's just not going to be on the table.
All right, excellent insight there, Will. Thanks so much for covering this for us. Will Kennedy runs the oil and energy coverage for us here at Bloomberg. Tom Petrie of Petrie Partners joins us now on the phone to give us his take. Tom, always great to hear from you. What do you think about the sort of stalemate that OPEC finds itself in right now? What kind of solution can you see?
I think first and foremost, the UAE has high confidence in its ability to bring on more production, and they are making this bid at this time, in my mind, for several reasons. Number one, Saudi leadership is somewhat in doubt compared to times past because of the legacy from the war in Yemen, which is a debacle, and the Khashoggi embarrassment that occurred. Secondly, Iran is looking to come back. They recognize Iran coming back could also be a market share challenge for them at the current levels. But most importantly, they are motivated to establish themselves as getting a better quota than they've had historically, because they have a better ability to meet future production needs of the globe. And I think you talked earlier today about a possible short-term deal, an OPEC breakup, or a realignment of volumes. And I think what they're really going for is a realignment of volumes. This is the opening bid for a discussion. It may well turn into a short-term deal while they have that. They're not fighting over price. They're fighting over the role they will play as we think about the next 3 to 5 years, and really a decade. And I would say climate change enters into it as well, because there are real questions about what the real long-term planning should be for OPEC, given the nature of what's happening in the Western markets, the global markets for that matter.
Yeah, well, in the Western markets or the integrated players, they have, in a sense, supply. A structural supply constraint, right? Because you've seen these activist shareholders jump up and say, on the one hand, you've got to lower your carbon footprint, and on the other hand, we want bigger payouts, so you don't have as much money for exploration anyway. What kind of questions and answers is OPEC going to have to the climate change issue?
You know, they're beginning to rethink what they want to get done, and it's become clear to them that they have a period from now till maybe 2045, 2050, that time frame, to harvest their petroleum resources and figure out what the nature of their economic competitive positioning is in a different, totally different context in the second half of this century. So they, you know, I think that is behind some of this. Most importantly, the UAE is probably the one country that has an ability to almost double output. Saudi, there's reasons to wonder, given the aging of the giant Guara field, given other issues that are going on. And then the challenge of Iran is very real. In the intermediate term, for the UAE, they know Iran's going to want to come back if, in fact, they do enter into another nuclear agreement. And I think you've got this other OPEC member staking out its position in future negotiations. How tough they stay on this versus willingness to embrace a short-term deal. They've all but conceded they'd do a short-term deal, but they've signaled they really want to talk about a more comprehensive realignment of quotas.
So
coming out of that.
It's clear, Tom, that the world wants to do another nuclear deal. Now we've got this political wrench that's been thrown into the works in the form of the recent Iranian elections. But can OPEC get a realignment done in time for Iran to come online as well?
Don't know. It's a hard one to call. I think that's one of the motivations for the UAE to surprise everybody. And you heard it in the Saudi oil minister. They've never done this before. Why now? Why now? I've cited several reasons. One, Saudi leadership in the UAE, in the Gulf region, isn't as robust as it's been in the past for the variety of reasons that have happened. This is not a desire to break it up totally, but this is a bid to say, give us more respect. We expect that. You pulled us into the Yemen situation. You haven't provided us with a solution to that one. And they're thinking more independently because they can see their opportunity in their development of their resources needing to be accommodated by other OPEC members, especially their neighbors.
Absolutely fascinating. Tom, great to get your thoughts on this. Always love to hear from you. Tom Petrie, Petrie Partners Chairman, talking to us about oil. Let's get to the Bloomberg First Word News now. For that, we go back to Laura Wright in London. Laura?
Thanks, Matt. Saudi Arabia and the United Arab Emirates have ramped up tension in their OPEC standoff. That's left the global economy guessing how much oil it will get next month. The Saudis want OPEC and its allies to increase production over the next few months and also extend its broader agreement to the end of next year. The UAE wants only a short-term deal. Prime Minister Boris Johnson is urging Britons to exercise judgment when coronavirus restrictions end. The government's preparing for the final unlocking of the economy in just 2 weeks. At a press conference today, Johnson will say the UK must learn to live with the disease as it does with the flu. The Vatican says Pope Francis is in a good condition a day after he underwent surgery to remove half of his colon. A spokesman said the Pope was alert and breathing on his own. He's expected to be hospitalized in Rome for about 7 days. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Matt.
Laura, thanks very much. Now coming up, mounting optimism surrounding the fate of a global corporate tax deal. That conversation next as ministers meet in Venice. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Markets. I'm Matt Miller in Berlin. The U.S. gaining international backing for a global minimum tax rate. German Finance Minister Olaf Scholz sounding optimistic about gaining eventual support.
We discussed about the success to get this agreement about a better taxation for corporates on the global level. And we made already the first step for this decision in London. Then we are now knowing that we agreed on in the OECD, and we will continue to work on it in G20 in Venice in a few days. Now I think we will have a good chance that this will be supported by the parliaments in the United States and at other places, because all know that this is better for our countries and for the democracy. We will have a fairer way of taking our own decisions on taxation, and we are not any more enforced to look at what the others do.
Did the Secretary of Treasury, Janet Yellen, did she, or yesterday I know you met with one of the Democrat chairs of the Ways and Means Committee, Richard Neal. These Democrats, they really think they can get Republicans on board to pass this, because Republicans in this country, Minister Schultz, do not like an increase in taxes.
What is sure is that the United States already have a tax, a unilateral tax guilty, which is similar to what we agreed on now on a global level. So I think there would be good reason for many members of the Congress to support this new international agreement, because it's in the end something which is a continuation and making it a good agreement on the global level. And now I think it is a good reason, because also for the Congress it would mean that they can take their own decisions on taxation, and that they have not to be afraid, because in some countries there is a lower taxation as it is in the United States, and this has negative impact on the strategies that could be followed here.
Let's talk about some of those countries in the European Union: Ireland, Hungary, Estonia. They are not signing on board with this global minimum tax. How are you going to get these countries to sign up?
130 states agreed. They are more than 90% of world GDP, so this is something. And on the other hand, I know that even in the past, many countries that were not supporting the proposals right from the beginning later supported them. There is a big train now on the track, and I think it will continue to go to its aim.
Anything you're willing to give to these countries to get them on board?
The experience in Europe was that all the global agreements in the end have been accepted by all the member states.
All the member states. Do you think that at some level, though, this isn't actually fair for countries like Estonia or Ireland and Hungary? This is their leverage to compete with powerhouses like the UK, France, and Germany. Do you think they're going to want more from the EU?
The EU is a very solidaric union. We give a lot of money to those member states who have the need for a better development. And even in this crisis, we developed a recovery program with, for the first time, a big figure of European bonds, and used this money for grants to those countries that need support in the crisis. So there is a cooperation which is really something all the countries in the European Union could rely on. On the other hand, it is not about the taxes a country has to raise. It's about that no one can make a business of the fact of taxing corporates that have no business in their own country, but helping them to avoid the taxes in the countries where they have their business.
And that was German Finance Minister Olaf Scholz speaking with Bloomberg's Anne-Marie Hordern. Joining us now is Jamie Cox of Harris Financial to talk about, what to make of these markets. Jamie, we've got so many moving parts for a holiday. It almost seems like it isn't. What do you expect, first off, to happen out of Washington? I mean, it's so important, I guess, to this phase of the recovery to continue to get funding.
Yeah, I don't think you're going to see much in the way of stimulus. I mean, if you take in any type of information from the latest negotiations regarding the infrastructure bill, it's going to be very difficult to get anything through this heavily divided Congress. So I think tax policy is something that investors have been worried about for the last couple of months, maybe even, since the new administration was elected. I don't think they're going to be able to do a whole lot in terms of changing tax policy. I know in your prior segment, you're talking about the minimum tax for global corporations and things like that. I think in the U.S., it's going to be a very tough sell to get anything through, even House Financial Services Committee, before you even get it to the House. And then when you get it to the Senate, good luck. With Senator Manchin and Senator Sinema, they're in a terrible spot with their elections coming up. So I don't think you're going to be able to do much in terms of tax policy, which is probably a pretty good thing for markets. I think that taxes and the changes therein will be a 2023 item, much in the same way as interest rates. So that's going to be pushed off into the future, which means that markets are sort of in sort of a blue sky area where you have low rates, you have plenty of stimulus that still is feeding through the system. You have a global reopening of the economy where it's sort of flowing from country to country as things get better with the pandemic. And then you have, not a lot in the way of taxation. So, I mean, it's a really good place to be for investors right now. And it will be that way for probably a year.
By the way, with regards to the global minimum tax, good luck getting it through the European Union as well. They've got 27 countries that need to ratify this, and at least 3 are against it. In terms of the U.S. specifically and, the fiscal stimulus, at what point does it start to worry you, Jamie, that we get to that cliff and there's nowhere else to go?
Well, with stimulus, it's an interesting thing. What you hope is when you introduce stimulus that it sort of gives way to, a maximum, sort of a stable and growing economy. And I think that's where the Fed is. They don't really know yet whether or not the stimulus is going to be this one-off thing where you get this big major fall off in demand after the stimulus is burned off, or is the economic recovery durable enough to be able to pick up the pace once the stimulus has waned? And I think that's one of the reasons they're being very, very, very patient on interest rates. But I do believe that a lot of people are missing out on the durability of this recovery. I think that people take a look at prior instances like the global financial crisis and try to, sort of use those as their base case for what the next couple of years will look like. And I think that that's missing the point. There is an enormous amount of economic activity that is pushing through the system now. And in addition to that, you also have some big global themes that have come through that are, sort of things that have happened during the period of COVID-19 that we haven't seen the benefits from. So the innovations in healthcare, some of the innovations in productivity from working from home, and we haven't really seen the benefits of those productivity gains yet. So I think we're going to see maybe some surprises to the upside that people are, not necessarily thinking that things are maybe not as good as they really are. And I think you're going to see that throughout the world, because you've seen Israel, China, U.S., Europe is next.
Jamie, thanks very much. Jamie Cox there from Harris Financial Group. More Bloomberg Markets ahead. I'm Matt Miller. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Monday, the 5th of July, live from London, I'm Guy Johnson. Alex Steele has a well-deserved day off today. This, though, is Bloomberg Markets. What have we got for you this hour? We're going to discuss the latest from OPEC+. Talks may or may not be about to resume. Sebastian Gali is going to be joining us from Nordea Asset Management. We'll get his take on that. We'll also update you on what is happening with Didi in China. China cracking down on the ride-hailing app just a few days after its US IPO. That seems strange, doesn't it? And we're going to preview what we can expect from a meeting between China's Xi and European leaders. That's going to take place later this week. As I say, though, it is Monday, the 5th of July. What does that tell you? It tells you that US markets are closed. 4th of July yesterday, as a result of which we have super light volume over in the States, i.e. none. Over here in Europe, we're down by around a half. So a very light volume session. In terms of kind of deriving clues as to where we're going next, probably best to wait until tomorrow. European stocks, though, are at session highs. The pound is catching a little bit of a bid. We're going to get a briefing from Boris Johnson at 5 p.m. London time a little bit later on today, talking about the reopening here in the UK. He's certainly pushing on with that. We've got Brent not knowing what to do. We're going to talk much more about what is happening with the oil markets throughout the hour. And I want to highlight as well one of the big deals that is certainly roiling markets here in London. We are potentially looking at Apollo stepping in to take out Morrison's. There's already an offer on the table, but there is this big question about whether or not UK assets are being sold on the cheap right now to private equity. We'll revisit that in a little while. But let's get back to the main story. OPEC Plus talks may or may not be resuming right now. We actually don't know. No signs at this stage that the healing that the group is looking for is happening. They're still trying to resolve an increasingly bitter split between Saudi Arabia and the UAE, the United Arab Emirates, that's blocking an oil output deal. Over the weekend, we heard from both of their energy ministers. Let's take a listen to what the two sides have to say.
We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment. But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend.
Okay, that's where we are. That's where the two sides are right now. Normally, Saudi and the UAE roughly on the same page. They are definitely not right now. Let's find out what the latest is. Let's bring in Bloomberg's Emma Ross Thomas, who leads our commodities coverage here. Emma, talk to me about what is happening right now. We still don't even know whether this meeting is going to be taking place.
That's right. So the meeting is meant to be restarting exactly now. Now, a small delay doesn't necessarily mean that it's not going to happen. These meetings often start late, very late. We've all sat through hours of of these meetings over the years. What we're hearing from delegates is that efforts to mediate, to find a consensus, have not yielded anything. We think, as I say, we think the meeting is about to restart, although some delegates are sort of questioning whether there's any point in sitting down to a meeting if no sort of progress has been made on the sidelines. As you said earlier, it's rare to have such an in the open spat between these two longtime allies. Those interviews yesterday provoked consternation among long-term OPEC watchers. Of course, we had the price war last year, but that was Russia versus Saudi Arabia. This time it's Saudi versus the UAE, or in the words of the Saudi energy minister, it's the whole of OPEC Plus against the UAE.
Yeah. I'm sure that is the words that are used on that side. The question, Emma, from the market's point of view, is a really tricky one. And the market seems kind of like a rabbit caught in the headlights at the moment, because on the one hand, you could have a lot more oil, or you could have significantly less coming onto the market.
Yeah, that's right. So I suppose one option is that they do reach some kind of consensus, and we'll have to see on that. If there's no deal, then the fallback option is to fall back, as it were, on the current deal, and that would mean no extra barrels in August. So obviously that would be bullish. But the alternative, the more dramatic alternative, of course, is the whole deal unravels, and that means a sort of free-for-all, if you like. And so that would be very, very bearish. Remember that last year the UAE did sort of float the idea of leaving OPEC. They never did it on the record. It was always in briefings, but they didn't, deny it either. We'll have to see whether that comes, whether that sort of is part of the discussion now. But certainly no one has forgotten that was a sort of threat last year when they first started talking about the baselines, which basically means the quota, the UAE's share of the production cuts, which they argue is unfair to them. They're happy to increase production in August, but they don't want to extend the current deal to the end of 2022 unless their baselines are renegotiated. That's the crux of this.
Okay. Emma, we look forward to the continuing coverage. Bloomberg's Emma Ross-Thomas. There is a T-Live, if you are interested, on your Bloomberg, TLIV. It's highlighted in red, the OPEC Plus meeting on output. Whether there is a meeting, we still don't know yet. Let's get more on what is happening with this story and the economic implications of it. Sebastian Galli, Nordea Investment Fund Senior Macro Strategist, joining us now. Sebastian, Emma laying it out, you could either have the kind of the fallback position where we get less oil than the market was anticipating, or we get a breakup, or we get some sort of everybody going in their own direction kind of scenario, and that could mean oil going down quite sharply. How do you, as an investor, deal with this situation? Do you just sit on your hands and wait for one of those two things to happen and then react?
In great part, yes, because it's a very uncertain situation. But what is most likely to happen is you're dealing with two close allies. As these close allies basically come into conflict, they go in public. And when they go in public, that means the population is being brought in. And that means an escalation process and then a de-escalation process. And that de-escalation process can take a week or 2 weeks, maybe 3 weeks. So we know that the deal, if it happens, will be dramatic in the sense that it is unexpected. The more likely scenario is then 1, 2 to 3 weeks down the road, we will get a deal with the UAE and its close ally, Saudi Arabia, agreeing to something. But for now, the face value is too strong. And so it's a dangerous moment. But I think the market will not know more this week as it will know not more next week. And then by that time, probably we're going to get a deal and we're going to be able to deal with the summer season of driving in the higher demand that is accompanying it.
Sebastian, Brent's at 76 right now. In that interim period, that is a huge period of uncertainty. Do we just sit where we are? Do we go down? Do we go up? I'm assuming there's going to be quite a lot of volatility here.
It's probably mostly to the top side. So people say there might be a breakup, but the breakup is much more dramatic than this. The odds are that people are going to test the new highs, and that's going to create a reaction function from the Saudis and others to try to get a deal because they don't want to kill the oil market. If there's too much inflation in the system, it, of course, is very negative for demand. It hits them in terms of substitution to electrical vehicles and other sources of energies. So they need to maintain levels probably around $80 to $70 for a significant amount of time.
Yeah. But in the interim, you say we could move to the upside. Is that up to 80? Is that beyond 80? If we get north of 80, do you start to fade the move? How do you play this?
Well, you're probably looking at somewhere around 80, maximum 85. And what you do is you don't fade the move because it can go very badly, very fast. And of course, what you hope for is that eventually it drifts down much lower. And as it does so, it helps a lot of assets which depend on lower oil prices and our inflationary nature.
Okay, so that was my next question. What is the derivative trade of this? If we are going to have this period when we're going to see oil prices drifting up, is it as straightforward as going out and buying the majors?
Well, if oil prices go up, inflation goes up, it eats into your disposable income. So, of course, it's negative for anything that depends on good demand, particularly in countries which are large importers. You can think of the Philippines, you can think of Japan. There's different ways, basically, to do it based on the metrics of imports all around the world and the different sectors. But it is just a negative shock. Now, $10 is not the end of the world, but psychologically, it can matter a lot. When gasoline prices go closer to $4 in the United States, there's an automatic hit in terms of what people do in terms of consumption, and that's going to be very negative for the equity market. So if oil prices do go to $85 to $90, you probably see a stock market significantly down on that one.
All of them? You need to subdivide and be a bit more nuanced than that, don't you? If you look at what's happening in the UK, heavy with oil stocks. Would Europe be a beneficiary if we were to see this happening? What happens in the United States? What happens to the oil patch there? You could, for instance, start to see some of the more medium-sized shale teams starting to think about pumping more. Just kind of walk me through how it plays out. People are very wary about owning the oil sector at the moment. Could this be a catalyst to suck more people in?
Well, what we know from the shale oil production is that they prefer to, until now, because they are so uncertain about the prices, to give back money to the investors, basically improve their balance sheets. And eventually what would happen is with higher oil prices, they become ever more profitable. And so production does increase, but increases a month or 2 months down the road, exploration and then exploitation, which takes place afterwards. And of course, it's very positive for this. It's very positive for the UK. It's very positive, of course, for Norway. Norwegian equities is very attractive from that point of view. And other places on Earth, such as the Philippines, of course, is not at all.
In terms of how this is going to affect people's view, as you say, of the inflation debates, will people view this as, and I'm going to use the word again, just a transitory factor?
It is transitory in the sense that we know that OPEC needs to maintain oil prices at a certain level to sustain itself. If there's a super spike, then we know what happens to shale oil. It comes online and benefits us very strongly, and then basically prices collapse. We know that they are looking at a shale oil and how shale oil production increases as a function of prices to set their own prices. So they need that production to stay not dominant. And generally speaking, it's how should I say? It's an interesting phenomenon that we have from an inflation point of view, but if you're based on the ECB or based on the Fed, they will look this as a transitory factor, not a permanent factor, and ignore it. But if it hits demand, then of course it becomes an issue. So you can have actually the Fed becoming less hawkish on the back of the fact that inflation has risen, which is a very strange thing to do, but a very rational thing from the point of view of the Fed.
Yep, you can't drive halfway to work. It is a tax at certain points. Sebastian, stick around. Plenty more still to talk about. Sebastian Galli, Nordea Investment Fund Senior Macro Strategist. He's going to stay with us. There's definitely more we need to discuss. It is actually a fairly busy week. Fed minutes, ECB accounts, lots to talk about. That's coming up. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome to the party.
Alex, I'm so thrilled to be here to finally celebrate our nation's birthday and to celebrate the return of live performances.
Yes.
Country road, take me home.
Come on and go with me. Well, no hatred, come go with me.
The 4th of July celebrations at the Boston Pops. US stock and bond markets closed, of course, for Independence Day. That was yesterday, but we're celebrating it effectively from a market's point of view today with US trading suspended. They'll be back tomorrow, of course. US markets kind of just drifting as we wait for the US return. But we finished with the fireworks there, so let's look at the week ahead. We do have the Fed minutes coming up. We've got the ECB accounts. Sebastian Galli of Nordea still with us. We finished the 4th of July on the fireworks there. Sebastian, any fireworks, do you think, from the ECB or the Fed this week?
I think the Fed minutes will be interesting because what you're seeing basically is a slow drift from ultra dovish stance to a more prudent risk management stance. And we know that the Fed is very much behind the fact, and we know this for the simple reason that it takes a long time for monetary policy to have an impact, and things are going well and they're going even better. So we know that they're behind the facts. And as it slowly prepares the market for a drift, we know that eventually we're going to talk about mortgage tapering probably before bond tapering, yep. US Treasury tapering. So the slow process has started. What they tell us, of course, is for public consumption. What they actually think is about the transition, and that transition is going to happen increasingly so in the coming month. So not a very hawkish Fed, but a Fed preparing itself, transforming itself like a butterfly about to fly. And that process is starting, and the minutes, of course, will reveal some of this.
Do you think this week, do you think there will be concern voiced within the minutes about what is happening with the housing market, which is super hot in the States? And the Fed, and many people could argue this, is feeding that heat at the moment by what it's doing in terms of buying MBSs. Do you think there'll be a hint, maybe, that MBS taper, as you suggest, could be coming fairly soon?
I think so. I think we're starting to see the first time is going to be very targeted towards the real estate market. It is doing very well for very, very good reasons. Low inventories, a lot of demand. Mortgage-backed securities are very tight. And behind that, of course, is the fact that the Fed funding is extremely cheap. And the bond purchases, of course, of MBS. It's a great story economically. It's very vital. So what they need to do is do something. And the first discussions have happened with one Fed member. And I think that's going to be revealed more in the Fed minutes. There are probably rising concern regarding this, and that's part of the slow preparation. This is like an army setting the battle stage to change, and that change it probably is going to happen in September with, of course, Jackson Hole just ahead of it.
Sebastian, I've got a VIX at 15. Are we going to see any volatility around any of this? Just briefly.
No, I think that it's preparation, it's subtle shifts, it's subtle signals which are being there, but the actual shift is going to happen much later. People are off on their holidays, relaxing. I think the market is not going to go through a bull correction, so it might have a liquidity gap. We lack the trigger for something bearish. We have basically everything for the reverse, which is to be a long equity with some prudence. And I think the VIX can stay at these low levels. Having said that, we're in absurd levels from an economic point of view. We know that the Fed has made everything very, very expensive, including volatility, and or make it very cheap if you want to, conversely. And that is unstable as a system, but it can stay in that narrative and that beautiful narrative for many weeks to come. I think it's next year that it becomes a very difficult story.
Sebastian, really appreciate your time today. Really interesting stuff. Thank you very much indeed. Sebastian Galli of Nordea Investment Funds. Greatly appreciated. Still ahead, China expanding its latest crackdown on big tech. It's moving beyond Didi, which is the kind of big headline over the weekend. 2 other companies now being pulled in. Both companies recently listing on the New York Stock Exchange as well. Listing in New York. We need to talk about this. What is happening here? US investors must be looking at this and scratching their heads and wondering what is going on. We'll talk more about this next. This is Bloomberg.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Laura Wright. A unit of Canadian investment firm Brookfield has agreed to buy recreational vehicle supplier Dexco Global. The price, $3.4 billion. Dexco makes axles and frames for RVs. Recreational vehicle manufacturers have gotten a boost from vacationers looking for safer means of travel during the pandemic. Shares of British grocer Morrison's have jumped today. Apollo Global Management says it is now considering whether to make an offer. Over the weekend, Morrison did agree to an $8.7 billion bid from a consortium led by Fortress Investment Group. Earlier, the company had rejected an offer from private equity firm CD&R. And that's the Bloomberg Business Flash. Guy.
Laura, thank you very much indeed. China's tech crackdown continues. Beijing has now banned ride-hailing giant Didi from app stores. This only days, I think it was last Wednesday, that Didi had its US IPO. Let's talk more about this. Bloomberg opinion columnist Shuli Ren joining us now to give us her take on this. Shuli, I looked at this over the weekend, and my first instinct was, are US investors being taken advantage of here?
I feel like, the Chinese have a saying called harvesting the chives, basically taking advantage of unsophisticated retail investors. There is this sense that Didi, basically raised 4.4 billion 2 days before this information disclosure from the cybersecurity watchdog. So there is a little bit of sense of Didi harvesting the American child, so to speak.
Okay, so the implication of that is that Didi knew that something was coming. Is that the correct assumption, do you think?
I think Didi knew that it had a lot of regulatory issues because in April, actually, it was summoned in along with 30 other internet companies by various regulatory watchdogs, antitrust, cybersecurity, tax bureau, so on and so forth. So it knew it had a lot of issues. But then, Didi was also an Asian unicorn, right? And then they have been receiving many rounds of funding rounds. So this perhaps is about as good time to go public as ever.
What do you think the implications are for future Chinese IPOs?
I think this comes at a very bad time because if you look at the Chinese IPOs on the U.S. bourse, June was a very busy month. Chinese companies raised almost $8 billion from the IPOs, the most since September 2014. And now with the Didi crackdown and 2 more Chinese companies that got just listed last month, right? Investors are going to take a second look and say, well, perhaps the U.S. government, the SEC, is correct. Chinese companies do carry a lot of risks. So this does not bode well for Chinese companies.
Do you think, what do you think that regulatory response is going to look like? As you say, the regulatory authorities in the United States have been warning and have been pushing back a little bit. Do you think we get a more serious and more sustained pushback from regulatory authorities in the United States about what is happening here?
I don't know if the U.S. government will move that fast. I mean, the SEC is still waiting to approve Bitcoin ETFs, so on and so forth, right? But the U.S. investors will do a little bit pushback because this Didi issue is quite new. In the past, we heard about antitrust regulation, crackdown, and stuff like that, and we knew basically the antitrust watchdogs were basically slap 2 to 3% of your annual sales as fine. But this cybersecurity watchdog is brand new, and they were talking about data security, national security, and then it could be anything, right? And then the cybersecurity law is very, very vague. The fine can be 1 to 10 times the so-called illegal proceeds. We just don't know whatsoever. So I think U.S. investors will have to take a step back themselves.
Shirley, we're going to leave it there. Always interesting, always interesting. Thank you very much indeed. Bloomberg opinion columnist Shirley Wren joining us on what is happening with Didi. We're going to kind of continue the theme in some ways next. We're going to talk about what is happening between the EU and China. There is now, it seems, a meeting slated between Emmanuel Macron, Angela Merkel, and Xi later on this week. It'll be a video conference. We'll try and figure out what that means in terms of the EU's relationship with China. We'll do that with Carsten Nickel, Teneo Intelligence Managing Director of Europe. That conversation coming up. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Farrow. This is Bloomberg Real Yield.
Half past the hour, live from London. I'm Guy Johnson. This is Bloomberg Market. It's Monday, the 5th of July, but US markets are closed for the 4th of July. As a result of which, light volume, but nevertheless some interesting gyrations, some interesting turbulence below the surface in terms of the sector story, which you can see here. So the Stock 600 not really doing anything. We're up by around 0.4%. That's the kind of the big picture story. But below it, look at what's happening. Banks catching a bid today. We're up by 1.7%. Barclays, one of the stocks that is leading that charge. You've also got the basic resources sector, the miners tracking higher as well. Chinese data helping out there. Glencore leading the charge. News on management in terms of the changes after Eisen Glasenberg stepped down as well, helping propel that stock. And then you've got the travel and leisure sector, which is certainly bouncing back. You've got some of the airlines beginning to track higher, maybe some more positive news in terms of reopening coming out of the UK. That is certainly something to watch out for. But the Delta variant, we still don't know what is happening here in terms of its trajectory and what implications there are going to be. Yes, cases are rising, but hospitalizations and mortalities still an open question. It was certainly a subject that was discussed a great deal this weekend down in the south of France, in the Luberon, the French Davos, Aix-en-Provence, the economic conference taking place this weekend in person in the south of France for the first time in 2 years. So French and European business leaders meeting in person to discuss the recovery, the political impacts, of course, of the pandemic. Caroline Conan was there. She spoke